Every year, Warren Buffett's letter to his shareholders comes out. And yeah, on the surface, it's a recap of the year. But if you know how to read between the lines, it is so much more. It's a masterclass in investment strategy. So today, we're going to deconstruct his 2011 letter and pull out the timeless playbook hidden inside.
So let's just start with this quote right here, because it sounds completely backwards, doesn't it? I mean, why on earth would you want a stock you own to go nowhere for 5 years? Well, understanding the powerful, kind of counterintuitive logic behind this statement, that is the key to thinking like a world-class investor. So, here's how we're going to break down this playbook. We've got 4 essential pillars. First, we'll look at how to measure what truly matters. Then, we'll get into how great companies use their cash. After that, we'll see how Buffett classifies every asset in the entire world. And finally, we'll talk about the psychological framework that really ties this whole thing together.
All right, first up, measuring true value. Look, the first and most critical step in this entire playbook is learning to ignore the daily chaos of the market and focus on the right metric. And for Buffett, that is not the stock price. It's the real, fundamental, underlying worth of the business itself.
Think of it this way. The stock market is like a manic-depressive business partner. One day he's euphoric, the next day he's in despair. The market price just reflects that crazy emotional volatility. But intrinsic value, that's different. That's what a calm, rational, long-term business owner would focus on, the actual fundamentals of the company.
What I find really fascinating here is how Buffett deals with this idea of intrinsic value. He's the first to admit you can't nail it down to an exact number. So what does he do? He uses per-share book value as a stand-in, a conservative, tangible yardstick he can use to track Berkshire's real progress over the long haul. And the results? Well, they pretty much speak for themselves. By focusing on growing this intrinsic value, instead of just chasing market fads, Berkshire compounded at almost 20% a year. The S&P 500? Barely over 9%. We're talking more than double the market's return for nearly half a century. The proof is right there in the numbers.
Okay, so let's move on to our second pillar and see how this all connects, the capital allocation playbook. See, once you understand value, the next big question is what a company does with the cash it generates. Share repurchases can be an incredibly powerful tool, but as Buffett points out, they are very, very often misused. So here's the crucial point. Not all buybacks are good. Buffett gives us 2 simple, totally non-negotiable rules. First, the company's got to have plenty of cash for all its needs. Easy enough. But second, and this is the one that's almost always ignored, the stock has to be trading for way less than the business is actually worth.
And this quote just hammers the point home. The single most critical factor in any capital decision, whether it's buying another company or buying back your own stock, is the price you pay. An action that's absolutely brilliant at one price can be value-destroying, just plain dumb, at another.
Which brings us right back to that weird quote about IBM. See, in 2011, Buffett had just dropped over $10 billion on the company, and he knew they were planning to spend another $50 billion on buybacks over the next 5 years. This was the perfect real-world test of his entire principle. And the math here is just so revealing. Let's say IBM spends its $50 billion when the stock price is low, around $200 a share. They get to buy back 250 million shares. Berkshire's ownership stake automatically jumps up to 7%. But if the stock price is high, say $300, that same $50 billion buys way fewer shares, and Berkshire's stake only grows to 6.5%. A lower stock price actually makes the company's capital work harder for the people who stick around.
Okay, on to our third pillar, choosing your investment universe. This is where Buffett takes a big step back from looking at specific companies and gives us this incredibly powerful first principles way of thinking about every single investment opportunity that exists. He basically argues there are only 3 categories of assets in the world. You've got your currency-based assets, cash, bonds. Then you have unproductive assets, like gold, that you only buy hoping someone else will pay you more for it later. And finally, you have the Holy Grail, productive assets, businesses, farms, real estate, things that actually create and deliver value over time.
And to really illustrate the difference here, he uses this just stunning example. Back in 2011, you could take all the gold in the entire world, and it was worth about $9.6 trillion. Just try to wrap your head around that number for a second. 9.6 trillion.
So he poses a direct question to us as investors.
If you had $9.6 trillion to spend, which of these two piles of assets would you rather own?
Okay, so Pile A is one giant, shiny cube of all the world's gold. It's pretty, but it will never produce a single thing. Pile B, for the exact same price, gets you all the farmland in America, which produces hundreds of billions in crops every single year, plus 16 companies the size of ExxonMobil, which earn trillions in profits over time, and you'd still have $1 trillion in cash left over. I mean, the choice is just so stark, it almost makes itself.
And that brings us to the final and maybe the most crucial pillar. Because look, you can have all the right formulas and all the right frameworks, but if you don't have the right mindset, none of it matters. This is all about learning to see market craziness not as a threat, but as an opportunity.
Buffett frames this whole psychological challenge with one simple question. If you know you're going to be buying more stocks for years and years to come, through your retirement account, whatever, how should you feel when prices go down?
Logically, of course, you should be thrilled, but our emotions get in the way. And this analogy just illustrates the absurdity of it perfectly. A long-term buyer getting excited about rising stock prices is like a daily commuter being happy that the price of gas just doubled. It makes absolutely no sense for your future self.
And this is it. This is the profound mental shift that underpins this entire philosophy. It's about fundamentally reframing a relationship with the market. The moment you see low prices not as a crisis, but as a gift, as your friend, that's the moment you stop being a speculator and become a true investor. And honestly, that might just be the most valuable lesson of all.